Now, I think one of the main reasons why we're gathered here today is a really kind of a rediscovery of an old finding that when you look at systemic large banking crises around the world, they tend to be preceded by booms or large expansions in private credit. Now, one question that kind of immediately follows from that I think has not really been addressed in as much detail as it should have been is what kinds of credit are we really talking about here, right? So obviously not all debt is created equally. And a lot of the emphasis that we've heard already and a lot of the emphasis in the academic literature has been on the issue of household debt, right? So how much does household debt matter for business cycles, but also for large systemic disruptions? And then, within household debt, there has been a lot of focus on residential mortgages, right? So as kind of the drivers of instability, I think we know much less, for example, about, what is the potential role for consumer debt, people taking out a lot of car loans, taking out a lot of credit card debt. And however, we also have, I think, some very good historical narrative evidence and also some empirics, at least for the US, by Holger Müller and Xavier Giroux, that actually when you look at expansions in firm debt, you do see that they, at least within the US, also tend to be followed by economic downturns. So again, the question is within that corporate debt now, right? Obviously, we don't think that all corporate debt is alike. So what are we really worried about? Is it that we're worried about construction sector debt? Are we worried about interfinancial lending? We've heard a little bit about that already. Are we worried that manufacturers are taking on too much debt and they kind of maybe are important in some areas and that causes problems, or agricultural debt? And now when you look at this slide, to me, we're more than a decade after the financial crisis. I think what's quite astonishing is that the honest answer, I think, to the question, what matters, is that we don't really know. Right? So I think it's really important to understand this, though, from a policy perspective. So while we're sitting here today, this year's going on has caused quite a bit of controversy, which is really quite rapid growth in the leveraged loan market. So the market for high risk corporate debt. And one indication of that is that the share of contracts that have been issued that are classified as covenant light, so those are contracts where creditors don't have a lot of rights to intervene with borrowers outside of distress, has increased quite dramatically. And if you look at the headlines, there's a lot of controversy about this, right? So some people are saying, look, this is the same thing that happened prior to the 2007 crisis. There's kind of increased risk taking, right? We see compressed spreads and so on. People are not taking into account the risk. The word carnage was used already. Yeah, that's usually not a good sign in financial markets, right? But other people, including the Fed chair, says, well, look, yes, there are risks, but it's not really systemic. Now, of course, it would be really, really helpful if we could go back to the historical record, right, and say, well, historically speaking, have systemic banking crises been preceded by corporate debt as well? Is that something that we can learn from history or not? Now, before we turn to that question, however, I think it's useful to just run through some very basic facts about what today around the world is it that banks are actually doing? What kind of lending are most common? I think that's important to understand before we go into the kind of nitty gritty. So what I'm showing here is that one of the, I think, most appreciated facts about modern finance, especially in advanced economies, is the rise of household debt. So Moritz and Oscar, of course, have done excellent work on this for advanced economies. I've basically extended that work to 120 countries, approximately, starting in 1940. So what you can see here on that side are advanced economies, and this line here shows you that household debt has really increased quite dramatically since 1960. Corporate debt has also increased, but much less so, although you see kind of this run-up up to the recent crisis. What I think is much less appreciated is that if you look at emerging economies over there, you see that also, although we're coming from a much lower level, you also see a really dramatic increase in household debt. And perhaps to me, even more surprising is that if you look at corporate lending over GDP in emerging economies, that has essentially been flat between 1980 and 2010. So I think that's something that hasn't really been appreciated, just how little corporate lending has grown in many places. Now, when you look at what is the composition of that kind of household debt, you do see that what Moritz and co-authors have called the great mortgaging, that in advanced economies, this really seems to be driven by residential mortgages. But if you look at emerging economies, you see that actually the share of mortgages and overall household lending has, if anything, slightly declined over the past 40 or so years. So that means in emerging economies, this is much less about mortgages, and a lot of the growth actually comes from consumer lending. These are car loans, these are credit cards, and so on. Now, what's interesting is that also, if you look within corporate finance, there's really been a fundamental shift in debt finance. So again, I'm showing you here just kind of a snapshot. These are OECD economies and emerging economies. And I'm simply dividing here the outstanding corporate debt. This is based on historical data here from many, many publications into the agriculture and industry components. These are the dark ones down here that you can see. And just to give you kind of a sense of the magnitude of what has happened, in emerging economies, for example, agriculture and industry accounted for something like 70% or so of corporate lending in the 1950s and 1960s. If you go there today, it's barely 20%. What's also interesting in OECD economies, for example, now lending to the construction and real estate sector actually makes up more of the corporate lending market than agriculture and industry combined. So that's really a fundamental shift in what banks are doing. Now, the next obvious question now is, okay, there are these kind of long-run secular trends, and I think that's informative, but should we worry about this from a financial stability perspective, where we have much shorter kind of time spaces? And one literature that has tried to address this already in a slightly different setting, and one interesting finding there has been in the international macro literature, is that when you look at episodes of large capital inflows, so this often accompanies large credit moves in emerging economies in particular, there does seem to be kind of a sectoral bias, a sectoral bend, where what I'm plotting here is simply from a nice paper by Talansis, that during large capital inflow episodes in emerging economies, you see that the non-tradable sector, so these are kind of local retailers, local wholesale establishments, or restaurants and so on, that tends to expand during these kinds of episodes. And from some recent work by Atif Mian, who was here yesterday, Amir Sufi, and Emil Werner, who's here, we know that in a completely different episode, in the 1980s banking deregulation in the US, we see that states that deregulated more and deregulated earlier, they saw this really striking expansion in employment in the construction, also non-tradable sector, while over the same time periods, we did not really see the same pattern for tradable sector. Okay, so this kind of already gives us a hint, okay, there might be something of a sectoral bias when we're thinking about different types of credit rules. Now, what I want to do with you is look at this much more systematically using this much more detailed cross-country data. And how I'm going to be doing this is with 108 countries for which we have both good data on these banking crisis dates combined with this really detailed credit data. And this is based on ongoing work here with Lou Liu, who's at Imperial College. And essentially, the first observation here is that if you just look at changes in the ratio of total lending to GDP relative to the country mean, we see this kind of familiar pattern. Okay, before a financial crisis, there's this expansion of overall credit. But then when you actually break this down to the components, one interesting thing is that you can see, yes, household lending does seem to expand slightly more maybe than the overall lending in terms of growth rates, but that seems to be especially the case just early before the crisis. What you can see is that immediately prior to banking crisis, on average, right? So we're averaging over many different experiences, many different countries here. You actually see somewhat of a slowdown in lending growth as you go into the crisis. If you look at corporate credit, you see kind of an entirely different picture, which is, yes, first observation here, there is actually kind of a positive deviation from trend in terms of corporate leverage as well prior to crises. But what's perhaps even more interesting is that you really see this spike immediately before a crisis hits in corporate credit. So there are many potential reasons for this, but one potential explanation is what we've seen in the US as well, that kind of early into the crisis, when people are already sensing or can already feel there's a crisis coming, what the corporations do is they just draw down their credit lines. So that's a kind of very intuitive explanation. But the point that I want to highlight here is, this kind of timing might be potentially very important when we think about what are the real causes of the crisis and what are just mere early reflections. Now, you also see almost the exact same picture if we use a bit more reduced data by non-financial corporations, which we can look at in more detail in a second. But first, for household lending, I think a quite striking pattern here is that it does indeed seem to be the case that most of this household lending pattern is actually driven by residential mortgages. So if you do a plot and you compare it with the consumer credit, so again, these are car loans, credit cards, and so on, you also see kind of positive deviations prior to crises, right? But the magnitudes are just somewhat more muted. Now, what I think is much more interesting is what happens once we start kind of decomposing what kind of corporate debt are we talking about here. And what I'm essentially doing is I'm going to be showing you sectors that you can kind of divide into those that really exhibit this kind of boom-bust pattern around systemic banking crises, and those where we see a much more muted growth. And of course, the first candidate, the maybe most obvious one that you would expect is, yes, construction and real estate lending, similar kind of to the residential mortgage expansion, does seem to grow quite strongly prior to these crises. You see an almost equivalent pattern for what has been called the non-tradable sector. So again, these are sectors that are just very dependent on local demand. They can't really export their way outside of an aggregate demand drop. And something I want to stress a little bit less is kind of the remaining services in here where it's somewhat unclear are those tradable or not. And as you can see, you kind of see this very strong spike prior to the crisis that I don't really know what's driving that. So I want to be a bit more cautious about that. Now, what we do know is that other sectors, so remember here the time, this is after 1940. Yeah, this is pretty much the universe of all systemic banking crises. If you're going to try and see a large agricultural debt boom, you're going to have a hard time. So maybe, in the US in the 1920s, there might have been a large boom in farmland, right? But in kind of modern financial systems, this doesn't seem to be the norm. Also doesn't seem to be the norm to see large expansions in lending to manufacturing. Also doesn't seem to be the norm to see a large expansion in what you can maybe think of as infrastructure, right? So these are transportation and communications. So I think it's really interesting that you see this dichotomy between different sectors, even within corporate lending. Now, of course, I'm cheating a bit here, right? Because we're already conditioning on, okay, we know there's a crisis, let's see what happened before. And the parallel is kind of, okay, we're looking at this ill patient, right? And we're doing all these diagnoses, but we don't really know is that the right thing to do, right? We don't really have a control group here, right? So as a result, one way to think about this is that, okay, this is kind of predictable misallocation, right? Or there's something that's kind of predictable about this sectoral bias. It has something to do with these crises. But I think it's also fair to say, well, there might be some regularities, but really every crisis is kind of different, and I'm conditioning already on a particular type of outcome. And really, the next crisis might just be, in Bitcoin or tulips again or whatever. So one way to get around this is that we can simply try and predict crises in a statistical framework where now we can use these different types of sectors and the shares of those different types of credit to try and differentiate prices from non-price sectors. So essentially, this is the exercise that I'm showing you here. So let me take you through what this here means. So I'm going to spare the nitty-gritty details, but essentially down here, I'm ranking these sectors by how good they are in a statistical sense to predict financial crises. Okay, so this does not mean forecast. It doesn't mean in real time. It doesn't mean that you should use this as a regulator. I'm going to get back to that in a second. But essentially, what you can see here is that I'm plotting you a bunch of models because I don't want to take a stand on, for example, what is the right lag length? How quickly do we expand crises to occur after a particular credit expansion? So for each sector, you see something around 300 different models. Some of these include advanced economies only, some are emerging economies only, some exclude different continents, and so on. So the first observation is that just, depending on how you specify these models, there's a lot of heterogeneity. But we can see a common pattern if we just focus on what is kind of the median model, right? So we have all these different estimates, but we do have what is a kind of a typical predictive ability of these sectors. And what you can see is that, as you kind of go more granular, you do get a higher predictability in terms of upcoming crises. But what I find most striking is that, again, if you go to this agriculture, industry, infrastructure sectors, if you want to predict a crisis with those, you're barely going to do better than just doing a random guess. Okay, that is kind of the takeaway from this order. Now, one problem of that, of course, is that all of these are just highly correlated because they're correlated with economic booms, credit booms, and so on, right? So it's really hard to tease out what is really going on the sectoral level. But one way to get around that is to say, okay, let's just control how much of a credit boom is going on. So I'm controlling here for the total change, the change in total credit. And then I'm just saying, okay, what do changes in the shares of these different types of credit in the total lending, what do they tell us? And what I'm showing you here are essentially the coefficients where it tells us that the sectors that have estimates over here, they would increase in a statistical sense the crisis probability, and down here, an expansion or a larger share of credit going to these sectors decrease the probability. And again, even if you use these shares, you can see that a larger share of credit flowing to non-tradables, to other services, to construction, kind of tend to not lead in a causal sense, but tend to be associated with a higher probability of crisis. While if you go down here, again, agriculture, industry, infrastructure, you see that they're in fact associated with a lower probability of experiencing a banking crisis. And what's interesting about that as well is that you also see that going to this kind of more granular level, it actually does help you in terms of your predictive ability. So in your classification ability, can you tell crisis episodes apart from non-crisis episodes? If you use this kind of more granular data, then you can see that it really helps, especially kind of the negative ones. So the ones that are where higher shares are associated with lower crisis probabilities, here like industry, infrastructure, and so on, they actually do help you in that classification ability. While if you go down here to households and corporates, if you only think about this in terms of households and corporates, actually that's not going to help you a lot in thinking about what type of credit boom is going on. Now, of course, kind of an easy takeaway that people have used, not necessarily from this, but like this general literature that, okay, there might be some sectoral bias is, well, then what does it mean? We should just do some kind of sectoral regulations, right? And in fact, we're already doing this because one example of that, of course, are the Basel regulations, which have the risk weights on residential mortgages that are relatively low, or a lot of countries are now doing macroprudential policy that's aimed at particular sectors. And so what I want to do is I want to push back a little bit on that and say, okay, are there maybe reasons why that might not be the best idea? So the first indication of that is that we just have to ask, in a kind of broader sense, can we actually predict crises in real time? So these kinds of exercises that I just showed you, they sound kind of nice, or we are predicting crises here, but it's a completely different animal if you're actually trying to do it, as many people that work in the private sector know, of course, right? Because it would be nice to know this and make some money with it. So what I'm using here is simply actual real-time forecasts of financial crisis probabilities that come from the BIS, who publish such forecasts. They perhaps telling they stop now, but they publish such forecasts in their quarterly review. And what you can see here is essentially the reporting will based on some metrics that they like the credit to GDP gap, the debt service ratio, and so on. Is a country at a high risk of experiencing a financial crisis? Well, this is relatively recent here. China has been high risk for a very long time. Canada, high risk. Yeah. If you look at Australia, well, kind of intermediate, but still there's some risk. Germany and Brazil is fine, according to the BIS real-time forecast. They do this for 38 countries, and what we can do is we can do the exact kind of same predictive exercise. Well, do these actual real-time forecasts made by the relevant regulators, do they help us predict economic downturns? So the first thing to realize is that, I'm not going to explain too much in detail here, but essentially what you would want to see is that, these forecasts should do really well in terms of classifying the world into true positives, which means, these are times when you call a financial crisis and it's actually a crisis, or you call an economic downturn, it's actually an economic downturn, and times when, you call it, but there's no crisis. You really want to minimize these guys down here, right? And so a good model would look something like this here. This is what people have used. Morris and others have used this before, which would be, okay, credit growth as a signal, right? This is in sample of banking crisis, and you see, most of the time you do better than this 45-degree line. You do better than just randomly guessing, right? So that's fantastic, right? Now, if we, however, go to the BIS forecast, where I should say we have much fewer observations than here, right? It looks something. So again, this is a good sign that we have this gap down here. That's what we want to see. But if you go to the BIS forecast, it looks something like this. So as you can see, we have much fewer observations, but essentially what this tells us is that, these forecasts are not doing better than just randomly guessing if you're going to have a crisis or not. These are the actual forecasts that we have, right? So you can pretty much get the same picture if you just say, okay, what is GDP growth down the line after you receive any of those signals, like red signal, yellow signal that the BIS actually assigns. And what you can see is that, first of all, you can't differentiate from zero, but even if you could differentiate the effect from zero, this essentially says 3 years after a country gets such a signal, we would have a GDP growth that is something like 3.2% instead of 3.3%. Right? So this is hardly like a macroeconomic disaster that we think about in terms of financial crisis. Now, I should say there are two caveats here. First, we're working with very few observations. And second, you could also interpret this as actually a great success story for regulators, because the alternative explanation, of course, would be, well, they issue some warning here. The local regulators know this. They react, right? They adjust monetary policy. They start with the macroprudential toolkits, and thus we never see a crisis, right? So this is a fantastic victory of crisis detection, right? That's the alternative explanation. So what I would just stress is that I think we also have other reasons to be, cautious about thinking about, what should we do in terms of financial regulation. And so the first one here is good old politics. So this here is one of my absolute favorite examples. This comes from Ireland from 2007. Now, many of you will know that Ireland experienced perhaps the largest real estate boom any country has ever experienced. Okay, this is a gigantic real estate boom during the time. In 2007, both the Conservative and the Progressive Party went on the election trail with the promise that they would abolish stamp duties for first-time home buyers, right? Where the idea is, this is kind of sometimes seen as a macroprudential tool, taxes, right, on home purchases. Let's abolish them. Let's give everyone a house, right? Remember, at the very height of kind of the boom. And so I think that's quite a remarkable example, and it turns out that this actually also holds true kind of on average in the data when you look at macroprudential tools. So this is some recent work that I've done, and where I'm looking at, here these are changes in sector-specific capital buffers. So these are risk weights on mortgages and these kinds of tools that are particularly aimed at households. These are just general changes in other macroprudential tools, and essentially what you can see is that if you're in a quarter prior to an election, regulation tends to be much looser, and it tends to be much looser when you're during an economic expansion. It tends to be much looser when you know that the upcoming election is relatively close, and so on. You get the idea. So obviously this is not conclusive evidence, but I think it should caution us a little bit when we think about macroprudential policy. I think a deeper issue here, though, is that when we think about this kind of sectoral sorting or the risks that might originate in different parts of the economy, I think we actually have a relatively poor understanding of why is it the case that you see differences across different industries? Why is it that you see differences between households and corporates to the extent that you do? And in fact, when I was putting together this paper, I found it quite shocking that it wasn't only my own ignorance, but it really does seem to be the case that most macro finance models just ignore this issue, which is why we probably don't really have a good grip on it. So, of course, that means if you want to design regulation, you want to really know what's the underlying theory, right? You really want to know what is the channel. Now, let me just offer a few concluding thoughts here. So, I think the first observation is that maybe the story about financial crises isn't as simple as thinking about household debt versus firm debt. I think we have to be a bit more careful when we think about this. And also, I would just want to make this argument that the current policies that people have in mind are maybe we're a bit too overly optimistic with those. Yeah? So I just I was asked to be a bit provocative in my assessment. So let's see what you guys think if this is provocative. So I mean, one potential way out, out of many, if you think that sectoral debt is actually a problem, which I'm not going to take a stand on. Okay, but if you thought, okay, as a regulator, clearly this is a huge issue, we need to do something about it, is to say, okay, we need something that is ideally immune to kind of political interference, at least in the most direct way, right? And maybe doesn't require us to do some real-time forecasting. But there's one really simple way, which would be, okay, you just put time-invariant caps on sectoral debt growth across the economy, right? So there are a million downsides, right? There are a million reasons why this is a really bad idea, right? But at the same time, right, if you want to do something, right, it's not that obvious that this is worse kind of what is the current policy framework. And that's just kind of to leave you with one example here. I think this really boils down to the question of, as a society, do we think that we need large banks in particular to hold concentrated portfolios, right? So there's no reason to kind of do this to small institutions. They can specialize, in shipping or mortgage finance or whatever, because they're not crucial to the macroeconomy. But take a look here at Deutsche Bank, at the two balance sheets here, their loan portfolio in the 1950s and today, and then I'm going to be done here. What you can see is that in the 50s, They did almost 60% of their lending was industrial lending, which was actually quite diversified in the sense that they were catering to many different sectors that are subject to different shocks. Today, they only do 9% of that. Retail and wholesale trade, maybe a little bit less diversified, but still they see this staggering reduction. They barely do any of that. If you look at their loan portfolio today, it's all real estate, leasing, or kind of interfinancial lending. So they're kind of very exposed to a particular type of shock. So I think, in terms of regulation, what you want to think about is how much are we losing if we force them to move a little bit away from this and a little bit closer to that, maybe with a more equal distribution. Thank you.
Okay, thank you. So I'm going to briefly summarize Karsten's paper. It's very composite. It has many sections, and actually in the presentation he added even more than the ones that were in the paper that I read, but that's fine. So I think that the main point and the main contribution is that he looks at the relationship between the increase in credit to GDP growth in specific sector relative to others and financial crisis, and whether in this relationship there is some predictive potential that can help us identify financial crisis possibilities. And in terms of his results, in part he confirms, but with a larger pool of data of countries, that in fact credit to GDP growth is associated strongly with crisis, specifically for the sector of construction and non-tradables. But then he adds that when you look at the share of the credit in especially the sector of non-tradables, you find a very strong association. And what's interesting is that it happens especially when the share increases at the expenses of the manufacturing sector share of credit, which is a very interesting point I found. Then he proceeds to discuss the policy implications, and specifically whether we need discretionary intervention, automatic or time invariant sectoral macroprudential policies and regulations. His point in this regard is that especially discretionary interventions are risky because they're exposed to, especially electoral cycle. That's your main point. On the other hand, we need better empirical results, and that's very clear. And I appreciated the caution with which you present your result. It's rare and very much appreciated. And so we need better results, and especially we need an economic explanation for the irregularities that we find, which is absolutely true. It's absolutely the case. So I really liked the paper for mainly two reasons. One is that it addresses a very important issue, and it does that in what I think is a smart way. So and the issue being that credit per se is too vague a concept, so is the aggregate leverage. And for one, in fact, credit per se can be a good thing, and a credit expansion can be a good thing. And, a firm can borrow to reduce its indebtedness, actually. And in fact, but even when it's a good thing, if we are to take Minsky seriously, it can, or actually it is bound to become a bad thing eventually. So we need to dig deeper, that's your point, and I very much agree with that. And various scholars do that in different ways. They look at the quality of the borrowers in terms of profitability and so on, and the quality of the lenders, like we said before, and type of loans and so on. The point that you make is where to stop. Where can we, what's the degree of disaggregation that's satisfactory from a policy perspective, because we need some efficiency also from that point of view, and that's a good point. And to that, you give us a suggestion, but you don't really answer fully. You don't say this is the way to go. But to make that point clearer, the fact that maybe sectoral analysis is the way to go, I think that perhaps you should try to replicate your results for a smaller share, like a more homogeneous group of countries, and compare how the results change. Maybe also give an historical break to see if there are types of regulations that kick in at a certain time, and so if that changes the situation as well. And that really would clean the results in terms of what's the global approach, what's the minimum amount of disaggregation that we can use globally from what are the country-specific policy challenges, which in certain cases have to do not to regulate with regulation, but with industrial policy, for instance. Like if we talk about big fish in small pond problem, like you mentioned, there's a problem of industrial policy, fiscal policy as well. And from that point of view, the other reason why I really like the paper is that you explicitly address the political aspects associated with policy, with economic policy. And that's important, I think. Especially you discuss whether it's good to have discretionary intervention, automatic interventions, where you should link that to estimates or not. And I very much agree with you that we should be leery of discretionary intervention, also when they are tied with the estimates. So there's assumed technicality about it, some sort of objectivity in that. I think we should be very careful about those. But not only because of the electoral cycle, but because, I mean, we know that we live in a world where, of revolving doors, for instance, that, is beside the electoral cycle for sure. But also in terms of global coordination, it's very difficult to have time variant coordination globally. So we need to agree on a setting that's time invariant to a large extent. When it comes to linking automatic triggering mechanisms to regulation based on specific like stress testing or some estimated indicator, I've studied these things for fiscal policy, but it applies to banking and financial markets as well. That's very risky because there's a political assessment there as well. And the weight you give to market risk relative to credit risk, we see that in the European Union, the Eurozone, the ECB, does not even mention market risk in the 5 priorities of the vigilance authorities. So, there are biases in estimates as well, and stress testing as well. So whatever we think is best to regulate, we need to do it keeping in mind that we need to create the best conditions to guarantee democratic accountability for these sort of things. And for that, I think the discretionary and timely, not so timely interventions is not the best way to go. Okay, and the other point is, so can we really regulate one single sector or a handful of sectors in the whole economy? I think that in that respect, to give an answer, you could perhaps look at specific historical examples. And one example that comes to mind is the household credit sector in the US. So we were discussing that last night at dinner, actually, the Marquette decision in 1978, the fact that when there's a very active monetary policy, for instance, it's very difficult to keep tight regulation of certain sectors, specifically if you want to have anti-usury laws, caps on interest rates, and so on. So if you want to regulate the household credit sector, you also need a stable monetary policy. You also need a macroeconomic framework around it that limits uncertainty, also for the financial actors. The other example, you mentioned Deutsche Bank, and in fact, that's my second example I want to make, and the fact that the housing market sector in Germany is very well regulated. In fact, they had no housing price cycle at all, as opposed to every other country virtually in the world. Yet the banks were very much involved in contributing to the boom of other countries, the US, first of all, and then later on also the countries in the southern periphery. And that made them extremely exposed and at risk. And in fact, they had to be essentially rescued by the Fed first, actually, and then ECB and the German government. So having the one sector regulated, but having capital flows allowed, and that sort of balance sheet allowed, composition allowed, still made the German financial system very fragile anyway, and probably still is. By the way. So yes, that's the other point. The final point I want to make is if we don't know much about financial fragility when it's going to actually trigger the crisis, perhaps we can look at how to the macroeconomic reasons why we want to regulate certain sectors. So for instance, the fact that the credit to households is regulated in a way that makes their exposure to sort of like deflation over time, that can help the macroeconomy not fall into stagnation. So that's still a good reason why we should regulate those sectors.
Thank you. A couple of things. One is the services, the movement. Oh, thank you so much. The movement towards services, I mean, inevitably so. And what is the most vulnerable aspect of that? The other thing is, specifically for the US, have you looked at the repeal of the Glass-Steagall Act, and has that changed the behavior, if you will, of banks?
Yeah, those are very good questions, and the answer to both is I don't know. So I don't know if that helps any at all. So I haven't looked at Glass-Steagall. Would be interesting to see. I think one takeaway there certainly is one thing that I've been thinking about for a good while which is related to that is changes in regulation are really key to understanding, I think, some of these sectoral shifts. So a lot of what large financial institutions do essentially, right, is to just adjust to the regulation and just kind of optimize how to work with any given regulation. So Glass-Steagall would be one example. Introduction of risk weights would be an example. So I would actually expect to see some large effects there, but no, I haven't looked at that.
If I think about some of the U.S. crises, the sector which seems to be sort of at the root of the crisis seems to vary a lot over time, right? So you had in the early 80s, it was lending to oil or lending to Latin America. In the early 90s, there was a lot of concern about the commercial real estate, and then you have a shift into concern about residential real estate in the latest. So given that sort of what sector seems to be changing over time, I guess I'm not surprised when you say that none of these are particularly predictive. And I guess it's would you be better served by looking at whether there's rapid growth in any one of these sectors and using the sort of that sort of without saying it has to be a particular sector. It's just that if something is growing really fast, and how these would compare to looking at, maybe that's why you're looking at overall credit growth might be a useful thing, because it's what sector is growing really fast has been changing over time, and that sort of benchmarking your results relative to looking at just total credit growth and the speed at which that's growing.
Yeah, that's an excellent comment. So essentially, the ideal, I guess, that you would want to do is you would want to say, hey, look, there are clearly secular trends in the growth rates, right? So that would imply that it's a really dumb idea, right, to just compare the growth rates, say, even to the country mean, which is what I showed you, right? On the other hand, right, the problem is that means if you don't want to do that, then you have to specify some deviation from some trend, right? And then, of course, things become very tricky, right? Because then you have to say, which trend, right? So which one's the trend? So to be honest, what I've done for now is to just kind of follow what the few existing papers on this topic have done, which is exactly that. You just look at changes of whatever credit quantity over GDP, right? And you work with that, completely ignoring the secular trends. But yeah, I mean, I would actually be very interested to see what kind of happens, right, if you try to more distinctly identify like signals, right? So, okay, your standard deviation above the trend growth or something, right? Yeah, and I can't tell you what the answers of that exercise would be.
All right. Yeah, just a very quick question. You seem to have shown that at some point there's a great increase in lending to services, category services other, that you seem to not really understand well, not understand, but I mean, you have a hard time explaining it. Could that be lending to just other financial institutions, maybe?
Yeah, so one one of the challenges with working with these types of data is that there's a fundamental trade-off, which is how granular do you want to go, or which is the one dimension, right? And the other dimension is what would you like your observation count to be, right? So I actually, to be honest, I haven't done it. I can break it out into lending to non-bank financial intermediaries, which are going to be a large part of this in some countries at least, like the UK, for example. I know that's a large part. And in fact, what you're saying makes sense, right? Like immediately before a crisis, you would exactly, expect that that kind of leverage really goes up because people are just trying to borrow as much as possible, kind of scrambling to get money together. So it's absolutely it's a possibility. If that's the reason, I don't know yet. Ask me soon.
Yeah, Natasha's is a good point. We saw a lot in Japan in the 1980s and 90s, where they kind of masked lending to real estate as lending to other financial institutions who are not specified, but are really all lending to banking real estate loans. But anyway, my comment is, first of all, absolutely terrific paper. Um, we've begun to think of it as there almost needs to be two scores. One set of scores are, about the acceleration of credit in sectors, but a second score is about the government's willingness and capacity to intervene. So, the United States in '08 has this let them fail mentality, at least for a while, whereas China does not have that mentality at all, except as it relates to peripheral institutions. And we saw China in 2000, the early 2000s, have an absolutely masterful plan to prop up banks that at that point in time had 30 to 40% of their loans were bad. And yet China just sailed through that by establishing bad banks, letting banks take back the equity in those bad banks at par, and investing excess deposits back to the bank as equities. So I mean, to me, it almost feels like there needs to be a score for the government's attitude and capacity around propping up institutions through, dysfunctional lending periods.
Yeah, that's very interesting. It's very relevant, obviously. So I think our next job here with this is, and that's why I try to kind of stress just how much heterogeneity you can see under these estimates as well, which is why I decided to plot it like that. That's certainly a very relevant kind of reason to expect heterogeneity in those kinds of things. Very happy to look at that. I do remember vaguely, I might be wrong, I'm happy for anyone to inform me. I do remember seeing that somebody looked at what is kind of the association, or what is the kind of a boom bust pattern between credit and outcomes depending on fiscal space as kind of one very poor but nevertheless proxy of, what is the government's ability to intervene in case something goes wrong. But yeah, that's interesting. Yeah? And thank you for the kind words, of course.